So like we said previously, the trade location is nothing more than where prices are opening based on, in day trading, based on the previous day's, structure. If you're a weekly or a monthly or a longer term swing trader, well, trade location is then more where are we trading relative to, the markets, if it's bracketing or trending, in relative terms, where are we trading? That is the trade location. So we use the previous day not for levels. Note, we don't go and look at the previous day and say, well, the market stopped at this low and stopped at this high, therefore that's support and resistance. No. We use the previous day to identify, things like value, things like balance, things like acceptance, important pivots where we might have seen initiative or rejection. That is what we use the previous day for. We use it to identify important reference points. Now, trade location is merely where trade is being facilitated today relative to yesterday. Okay, when we use the trade location to interpret market weaknesses and strengths, we can then determine whether there's confidence or a lack of confidence. So for example, let's say the previous session we had a relatively muted session, a balanced market trading within the previous day's value accepted area. Now, on the next morning, the market tries to open drive, but cannot, see the kind of volume and volatility it requires, to continue and extend to the upside. Now, straight away, we expect to see confidence with an open drive. So if we're not seeing it, it's telling us that, whilst there might be a little bit of confidence, it's not as strong. So we lean on the previous day's sort of referencing points to determine the level of confidence or lack of confidence. Then the three trade locations or basic trade locations we get that we can identify based on the previous session are, firstly, if we open in value area. So if we open within the previous day's value area inside of the previous day's range. The second trade location is if we open outside of the previous day's value area or accepted value area, but still within the previous day's range. And the last trade location is if we open up completely outside of the previous day's value area as well as the previous day's range. Now, straight away, you should be saying in your head, we're going from balanced to more imbalanced in terms of our trade location. If you've just caught that, then you understand why we talk about trade location. The further we open away from, the previous day's value area and range, the more likelihood there is for excessive volatility. Now remember, volatility does not necessarily imply volume, but it does potentially imply opportunity. Why? Because it's bringing and forcing other time frames as we're advertising quite substantially different prices from the previous day. So simply, keeping track of where the market opens relative to the previous day's range and value area is a valuable market-generated piece of information. A market that opens within value is generally in balance and waiting for new information. A market that opens outside of value is out of balance and carries it with it greater opportunity and risk. So by using the previous day's factual information combined with the opening auction process, we can trade more objectively, and that is why we identify the trade location based on the previous day. The basic premise: if we open in balance, there is equal opportunity for us to move up and down. The further we open away from balance and potentially outside of range, the higher probability for volatility, and this brings greater opportunity as well as obviously greater risk when trading. Identifying this, we need to use the strategies that will best allow us to take advantage of those opportunities, based on where we're opening in terms of the trade location.